Hello and welcome. You're watching KYC. Here's a stock that from maybe the 7th of April has rebounded extremely sharply. It's given a 50% return to investors. It's an interest rate sensitive company as well. We've been very conscious of the fact that today is the big repo rate decision, and while there's been no action there, we've seen plenty of action with regard to the repo rate over the last 3 meetings that the MPC has had. So we've kept that in mind when we've slotted this one. We're going to talk to Prestige Estates. No small company. It's a sub 70,000 crore market cap company. So it's quite a large company in relative terms. Now, what I want to know, and the first thing I'm going to start off with is with approval delays. We've seen approval delays happen in FY25, which has dragged the numbers a little bit, including the cash flow number of the company for FY25 because there's been that inventory build-up. Are we seeing an unwind? The reason given for the approval delay was elections, and a lot of that would hopefully start unwinding in FY26. I want to know the extent of that and how will that impact the numbers. The second one is demand sustenance. We've seen very, very strong demand already in this space. Also, there has been a build-up of inventory in Hyderabad. Why is that so? Can we possibly see an unwind there? Is there a demand problem there? I want to understand some of those pieces. In terms of pricing, now that too has seen extremely aggressive increase in terms of the realizations. Is that sustainable? Are the average realizations at the current juncture, is there an upside surprise even from here? Are they going to sustain at the current level? What's the trend that's playing out? Update on the hospitality demerger business. This could be a big value unlocking opportunity for Prestige and its shareholders. Expectations with regard to margins. What's the risk of construction inflation coming in and impacting the margin number will be the other piece I'd want to understand. Funding of the very large 20,000 crore capex that they have in terms of a pipeline over the next 3 to 4 years. And how is the luxury market doing in terms of demand? Is that demand holding up? I'd want to understand all of that. I'm Harsh Saita, with me is Anushi Vakharia, and we're going to take you through the next half an hour on Prestige Estates, and she of course tracks realty extremely closely. Let me start, Anushi, with what the company does, and then probably I'll hand it over to you for a little bit of those factors. Let me start off. It's a real estate company, but it was founded way back, 1986, has 39 years of history. It was traditionally a Bangalore-based company, has now diversified into 13 locations in India, has completed over 300 projects spanning a developable area of 20 crore square feet. That's quite large. It's completed over 150 residential projects. But what does it do? It's diversified. So 150 residential, but there are plenty of commercial and other opportunities as well. So the diversification comes from residential, office, retail, hospitality, property management and warehouses. All of that is what it covers. Now, maybe some of these are smaller parts of the business, but at least the top 4 are large parts of the business. Residential, retail and office, hospitality. Those 3 are huge. In terms of the projects which are ongoing, there are 63 projects which are ongoing at this point. That's the split between residential, commercial and retail on the ongoing projects. The upcoming projects, there are 69 upcoming projects as well. So this is no small player within the real estate market. It's spread across the top cities of the country and has an extremely large presence and multiple projects which are ongoing at the same time. That's the upcoming projects, which is 69 projects which are upcoming broadly. And that's the split with regard to that. Let me now talk about the this is the FY25 geography split. This shows the largest market is Bengaluru, which is 45%. Mumbai is then 30% of the market. Hyderabad is 23%. And then 2% is the rest. I want to also understand whether NCR is going to become something of a large market for them, because they ventured there, but they're playing small at this point, Anushi.
They are coming, they have launched the Indirapuram project. That's the Prestige city that we are looking at, and it's a big one. You know, if you just look at the pre-sales number that we'll discuss later, that would reflect just in the mix itself, 59% of the geography split now coming from NCR, then Bengaluru followed by about 20% or also, and Mumbai having a 12% of a chart over here, and the rest followed by with a 5 to the 1% of a mix, right?
Viewers, for perspective, the earlier chart was FY25, the current chart is Q1 FY26,
Yes.
and that shows the tilt that NCR has suddenly had. Now, question of course is this is a one-off quarter, and generally in real estate it's chunky.
Yeah.
But of course it's starting to add up. It's starting to reflect.
Of course, emphasis would be besides the South markets now, how would the market share in these other markets develop going forward?
Absolutely,
Yeah.
absolutely. But land bank, Anushi.
Yeah, if you talk about the land bank now, currently, this is a big figure that we are looking at. It has 825 acres of land bank. And in fact, Prestige share in this is roughly around 704 acres or odd so. So it's not certainly a small amount of land bank that we are looking at. And this is, of course, in the next like a long period that we are looking at. So that would remain interesting to watch out for how the launch pipeline is, considering not just this year, for the next 5 years or so as well, right?
Yeah, absolutely. So execution will hold the key. We'll also have to see how many launches come through, as Anushi is saying, but the land bank is obviously large. And of course, there was a period of time in the 2000s when most real estate companies were valued just on the basis of land bank. Right now it's shifted more towards pre-sales, but back then as well, the land banks were really the metric to say that there will be growth, and hence the land bank becomes important, but not as important. And we realized that between 2010 and 2020 as the pressure on real estate mounted. But now, of course, we are in a favorable cycle, and therefore Prestige could well be on the list of stocks you want to keep on your radar, because you're in that favorable cycle for the next few years, and there is diversification in this one as well. Let me start off with the metrics as well. Let's talk about the 8 metrics we'll talk about. We'll talk about the operational metrics first off, as we would within real estate companies. Then you have the income statement, balance sheet, cash flow, everything else remains the same. We'll look at shareholding pattern, street cred, street coverage, and outlook. That's how we'll space it up. We'll also give you a little bit of color on valuations. And we will also try and we'll get you perspective, of course, from the management when we speak with Mr. Irfan Razack, who will be joining us in a few minutes from now. Let me, though, allow Anushi to start off with the operational numbers as well as the income statement. I've spoken enough, Anushi.
Yeah, right. So I'll start off with the key operational numbers that you look at. And as Harsh emphasized on the pre-sales number, now if you are looking at pre-sales in the last 3 years or so, we have looked at a strong growth trajectory here, 90% or even 63% of a growth that we'd seen in FY22 to 24. But FY25, if we look at now, that was a blip, considering that there had been approval delays which led to the launches being deferred to FY26, as we've seen about a 19% of a downtick in the FY25 period, the target being 24,000 crore or odd so of pre-sales, but the company clocked in about 17,000 crore. Collections, if we see, that has also remained on the healthier side, but FY25, again, almost flattish kind of a collection growth that we are looking at. But what is surprising is the average realizations, which have continued to clock in that double digit of a growth. In fact, if we look at FY22 to FY25, the realizations have in fact doubled from 7,500 per square feet to 14,000 currently. Launches also, if we see now, launches in FY25 added to about 14 million square feet. But if you take the first quarter in perspective, they've launched almost about 14.94 million square feet in the first quarter itself. So how the launch pipeline would be for FY26 is something that we should be watching out for. But Q1 FY26 in general has been a turnaround for the business. If you look at the pre-sales, they were up around 300%, collections up about 55%, even in average realizations and area sold, we are looking at an uptick. This is on account of the strong project launches that have happened. First, the most prominent one being the NCR one that we just spoke about earlier as well. So this is the kind of picture that we are seeing in the key operational metrics. It's a thumbs up if we take the long term in perspective, and FY25 being a blip year for the business. But of course, emphasis would remain whether these approval delays are still a factor which is playing on or not. In terms of how the income statement has shaped up now, we'll cover this in very brief, since we are looking at a lumpy set of numbers when it comes to real estate companies. Revenue has seen about a 5% of a CAGR growth in these 3 years period that we are looking at. Margins more or less have remained in the 25 to 35% of range. The company did say going forward that the new acquisitions that they will make will enjoy a margins of 30 to 35%, while net profit stood at 617 crore at the end of FY25. So Harsh, this is the overall picture that we are building in terms of how the operational metrics and the income statement has been over the course of FY22 to FY25, even the first quarter now being in the recent focus.
Right. Anushi, let me throw in a question here. Any concerns with regard to the Q1 FY26 numbers as you see it?
If you look at the Q1 FY26 numbers, in fact, it looks like a turnaround for the business, considering that there were issues in FY25. But now the company, even if you look at the margin numbers, that has been in the range that the company has given. Revenue is also up around 24%. But of course, it's the key operational numbers that we are looking at, and we are looking at strong set of numbers coming in from here.
Sure. So Q1 FY26 was decent, even though the stock not really reacting to that. Let me look at the balance sheet now. And your equity has gone up in FY25 because they did a 5,000 crore equity raise there. As Anushi did point out, FY25 was a year where you did see some headwinds, which has impacted the numbers, and therefore the equity raise was necessary. The book value currently stands at around 15,000 crore, as you can see, and its market cap is around 70,000 crore, which we've spoken about. The borrowing is at around 10,600 crore. So yes, the borrowing number is elevated compared to the equity or the book value, but basis the market value is still okay. When you're looking at roughly just the profitability metrics on an annual basis, the cost of borrowing is around 10%. And the net debt to equity is around 0.4 odd percent. So the net debt to equity number is roughly 6,900 crore, which is also elevated because on even if I ignore FY25, if I take FY24's EBITDA number, that's around 2,500 crore. The debt servicing will require nearly 1,000 crore at 10%. So therefore, you want to be cautious with regard to how the balance sheet is playing out and how the cash flow numbers will play out with regard to Prestige. And let me also look at cash flow actually. Anushi, I'll take this one as well.
Yeah.
The cash flow from operations fell in FY25. And understandably so, we spoke about those trends playing out, even though the EBITDA was 2,558, and therefore, really not translating to net cash in terms of even operationally something substantial coming in on the operating cash flow front. So both of those headwinds being seen and being faced, cash flow is certainly something that even analysts as well as us, we're all looking at, and investors should also keep a watch on with regard to how cash flow pans out. But shareholding, Anushi.
Yes, so in terms of how the shareholding has panned out, you know, in 23-24, we've seen about the same sort of a mix in terms of where the promoter holding is concerned. 65.5% is the mix that we are looking at. Now, taking the recent June 25 in picture, that stood at 61%. Of course, you know, the equity raise also that took place last year playing into effect over here. FIIs hold about 16% as of the end of June 25, while DIIs also have a significant stake at about 19.6%. So, overall, if you see, it's a thumbs up given that, you know, it has more or less remained stable in terms of all these three promoters, FIIs and DIIs holding that we are looking at. With that, you know, I'll also quickly cover the street cred which is there. Now, if you look at how the performance has fared out for the business, in the 1 month or so, we have seen about a 2% of a downtick. 6 months, the stock, as you know, Harsh did say in the start also that from April it did see some recovery. 17% is kind of gains that we've seen in the last 6 months or so. But 1 year, the performance has been lackluster, considering the previous, you know, headwinds which were there for the business in FY25, minus 3% is the kind of return for the shareholders. But for 5-year periods, it's been an absolutely multi-bagger for the investors holding it, 7 times the returns that we are looking at. So, Harsh, that's a picture that we are building for these two metrics.
Perfect. Analyst recommendations, a clean thumbs up there. 18 buy calls, just 1 hold, 1 sell, 18% return potential. No concerns there, nothing to justify. Outlook ahead. Well, you're looking at FY26 pre-sales in the region of 25 to 27,000 crore. Very, very strong guidance on pre-sales for FY26. Given the slightly lackluster FY25, we've seen GDP pipeline is also strong. Management is targeting a margin on fresh acquisitions of around 30 to 35%. The otherwise margin guidance is 25 to 30% aspirational. That's really the thought process. Free cash flow from ongoing plus completed projects, very important metric when it comes to valuing real estate companies. 21,000 crore versus the 68,000 crore number that we have for with regard to the market cap, and around 50,000 crore is the GDV number versus the roughly 70,000 crore market cap that Prestige currently trades at. Let's stack up therefore all of the metrics and give Prestige its final rating. That's how it stacks up on all of the 8 parameters, and on a final rating it gets a very, very healthy 5.5 on 8 on our KYC ratings. But let's go across. We have Mr. Irfan Razack joining us this morning from Prestige. Sir, firstly, thank you so much for doing this. I want to first start off by understanding from you, sir. We've had more of a macro question, because just given the setup today, it's good to have that perspective from you. We've had 3 rate cuts back to back, 1% shaved off from interest costs for your customers. Are you seeing, versus January, are you seeing positive momentum in the last 2 months when it comes to business? Is it picking up, or does it not impact your customers, or is it status quo?
No, obviously rate cut does help the customers. It makes the product that much more affordable, in the sense that they can buy a more expensive product, they can take a larger home loan. So that helps the cause, because as it is, real estate prices, because of all input costs going up, have gone up, and the rate cut has helped them to at least buy their dream home without really getting into any sort of stress. So, and the business goes on as usual. And I believe that that is a very, very big plus. Even today, I think the RBI has just kept the same numbers, and which is, I believe, the right way to do things. And in the long term, I think things will stabilize, and it will help the business as we go along.
Mr. Razack, this is Anushi joining in as well. Another macro question to you before we talk about the company-related questions is about the luxury market in general. You know, now there's a debate across the industry that we are looking at, that if we are taking this year in consideration, there are expectations of now there being growth slowing down as compared to what we have seen in the last 2 years or odd. So this is in terms of how the launches have been, how the growth has been. Just want to understand your perspective on the same.
See, we first of all need to know what we defined as luxury. Now, according to me, luxury is anything above that 3 crore brackets, getting into 5 crores to 50 crores, the premium. Maybe it's gone above that also in a city like Mumbai. So now, but if you ask me, the market which is evergreen and which always, where there's a need and the demand will be constant, is in the mid market. That is that 1 crore to 3 crore range of product. And as we go along, as we go higher, and the luxury market is a very small niche market. And that is a different breed of buyers that are there in that market. And honestly, they don't have any urgency to buy. They will buy only because if they like the location, if they like the product, and then for them, price is the secondary item. So we really can't compare that at all. And that's not a benchmark. For me, the benchmark is, as long as the mid-market is doing well, as long as job creation keeps happening, and as long as interest rates hold, and I believe that we'll keep selling, and that's where the business will keep coming from. Yes, we are present in luxury in cities like Bangalore, Mumbai, and as well as in Hyderabad. And those cities do give us that business, but it's a small percentage of the overall business that happens in our company.
Got it, Mr. Razack. So, last year you saw some delays with regard to approval. Give us some color on what's happening this year. Has there been a bit of a change? Has there been a sea change? What's happening on ground?
See, now, last year, the delay of approvals is because the entire official machinery was busy with central elections, state elections, and all of that. That is behind us. According to me, see, there's a very, very defined code that is there in all the cities that we operate in. Everybody knows that what's the type of approval you can get on a particular piece of land based on the roadway, based on the location and all of that. And if we are designing our product accordingly, it's a procedural thing that keeps happening. And sometimes things move a little slower than required. But then I think in a normal cycle, approvals do take time because there's just not the final approval that has to come submitting it to the authorities. You have to get at least a dozen clearances, NOCs, including environment, fire, and so on and so forth. So all that takes time. So I think from the time we touch a piece of land, do the planning, and then bring it to the market, it takes at least a good 15 to 18 months.
Mr. Razack, just with that, if you are looking from what has happened in the first quarter, we are looking strong set of numbers in terms of how the pre-sales have been, how the collections have been. Of course, emphasis being more on the NCR region as well with the launch of the project over there. Just want to understand your sense in terms of how FY26 is expected to shape up. What is the kind of GDV potential that we are looking at in terms of new launches which are there? Along with that, you've achieved almost 12,000 crore or odds of pre-sales in the first quarter itself. So with that, do you see a revision in terms of the guided number which you've given for FY26?
I mean, it's what we guided in the beginning of the year was around 25,000 crores, of which we've done almost half of it in one quarter itself. Now, what does it mean? It means that there is more potential, and we have to bring in more product into the market. Currently, we hold an inventory of about 20,000 crores, and we have a GDV in the pipeline of another 42,000 crores. That takes the entire stock that will come in eventually at 62,000. But that now it all depends on how quickly I can bring in that 42,000 crores to the market. And that is where all the approvals, that is where the RERA clearance, all that plays a part. Any slip, one or two projects get delayed. That means that 42 will spill over to the following quarter or following financial year itself. So it's a matter of how quickly our teams can bring these properties to market. And if we are able to, and I certainly believe that once we launch, we normally sell between 30 to 50% in the first quarter of launch itself. So that since the market is still good, it's robust, there is demand, and and our locations are all fantastic, and if we price the product right, I don't see any stress in achieving that target or exceeding that target. At least this year, we will definitely surpass the target that we have guided for.
With this, the 42,000 crore of GDV pipeline that you just mentioned about, I just want to understand, like with this, how the other metrics are expected to shape up as well. Collections in FY25, while we did see about flattish kind of a growth, how is the trajectory for FY26 that you're looking at? And is the pricing growth also of this double digit expected to continue with this?
See, now, as far as collections, this quarter has been the highest collections that we have done in any single quarter, and it's around 4,500 crores. Again, it's a function of the sales that have been done and a function of the pipeline collection that has to come. And I believe this will be the trend for the next 3 or 4 quarters. If we launch more, sell more, obviously the collections also will be higher. And if you ask me, pricing, I believe pricing have reached a certain peak, and I personally wouldn't want the pricing to go too high too fast, because then it breaches the affordability barrier. So we would like to see if there's pricing, it should be linked to inflation, it should be linked to the overall input cost, and it should not be a speculative pricing, which will eventually hurt the sentiment and the company.
So the other big piece within the Prestige setup is with regard to hospitality. How quickly can the value unlocking happen?
See, the good news is we had filed the DRHP in April. Then we got clearance just about a week back with certain comments. Those have to be addressed. In the meanwhile, the teams are on road shows and trying to get the investor interest. And if everything goes well, we should be able to conclude this entire hospitality IPO by mid-September.
And so are you comfortable from a cash flow perspective? No concerns there? Sorry, sir, I just have 10 seconds on this one.
No, we have always been comfortable on cash flows. I believe that there is a healthy cash balance that the company has, and also the sales are also there. So there's a big collection pipeline. Where the capital is required is all for our capex projects like office or retail and hospitality. Now with the unlocking of hospitality, even that particular asset class will be a separate company and will stand on its own feet. Yeah, and eventually, even office and retail, once we come to a critical mass, we believe there's a huge potential to unlock the value. And it's a game plan and a strategy. I believe that the company is only getting stronger day by day.
Excellent. Thank you so much, Mr. Razack, for coming in and chatting with us. This has been truly meaningful. Thanks from Anushi and myself, and viewers, frankly, out of time on this one. From Anushi, myself, everyone who puts the show together, thanks so much for watching.